A name that haunts a lot of traders, especially the OG ones back in 2023, who were fully funded with them. My Forex Funds was one of the top prop firms in the entire industry, and they got completely taken down. But before they did, they actually revealed a lot of information, and a lot of it was shocking. To be honest, at the time, many people were thinking this entire prop firm industry is on its way up. And, people were thinking they were even into live funding and all that type of stuff. But they revealed a lot of things. First of all, none of the funding is actually live. It's all simulated demo profits. From that point onwards, what you would actually see is a lot of the firms revealed a few things where they all say they're now simulated firms. Another thing, their pass rate was only 8%, the people that could pass phase 1 and phase 2. The first payout rate was 0.28%. Now, let me just remind you, out of 1,000 people, that is 3 in every 1,000. An entire room of 1,000 people, only 3 to get completely funded and get to that first payout stage. So we saw what the stats were actually like. It's dreadful. This entire prop firm world is actually rigged. And when you really look at it, it's us versus them. And the thing is, we actually need to come out on top. Too many people are spending thousands and thousands on literally prop firm challenges to just keep failing and failing and failing. To be honest, the prop firms, it's not their fault. They understand the psychology of all these traders, and that's what they're trying to hone into. Now, let's get this one thing straight. We need to have a proper plan and figure out the most efficient way to actually pass these challenges before spending another dollar on any of them. So, brave Mr. Diamant Capital is here to come and save the industry. Now, I know it's a bit of a joke, but seriously, we need to look at prop firms from a different perspective and see what's the quickest way we can scale with efficiency. But the main issue is this. They become so accessible that a lot of traders are rushing into challenges and failing. You probably know yourself, or maybe you are even a trader yourself that has literally put a lot of money into the trading, and eventually you're just, trying to pass, but keep failing and failing and failing. Now, in this video, what I'm going to do, I'm going to break down every single risk management plan and evaluate which one is the best to use for all these prop firms. What I've actually gone and done is I've used ChatGPT throughout this entire thing, literally to evaluate which one might be the best. By the way, if you don't know me, my name's Diamant. I've been trading full-time for 4 years now. I've mentored close to 3,000 students, and most importantly, helped hundreds get funded, and who are now, more importantly, making 4 to 5 figure payouts. So I think I know what I'm talking about. Now, let's take out your notepad and let's get started. Now, in terms of how we're going to proceed throughout this entire video, I'm going to break it down into 4 simple formulas. The first one, the pass expectancy, lucky streak, failure expectancy, and then the Monte Carlo formula. For those of you that know what that is, we're obviously going to get into it. The first one is the pass expectancy formula. This is probably what most of you are actually looking for. Now, I'm pretty sure most of you have a strategy. You have some type of idea of what's going on the market. But where a lot of you actually mess up is your risk management. And to be honest, that's one of the most fundamental things we should not be failing at all. So we're going to explore that right now. Now, typically speaking, the spectrum of win rate ranges from 0 all the way to 100%. And your risk to reward will obviously differ. You could go up to 100 risk to reward, but it's just not realistic. Now, what I've gone ahead and done is I made this little matrix. The expectancy essentially is a formula comprised of the risk to reward and the win rate. We range from 30 to 50 to 70. Now, with the general conditions, and these are the harder conditions, that we've got a 10% max drawdown limit and a 10% pass-in limit as well. For example, on FTMO or any of these bigger prop firms, that's the number that we've compared to. Essentially, if you want to be in the clear, what you actually want to be going for is a 50% win rate with a 1 to 3 risk to reward. You can clearly see a 30% win rate with a 1-to-1 will eventually lead to fails. So what does this all mean? On average, with every single trade, you are going to pass at some point. Whether it's 10, whether it's 20, whether it's 30 trades or more, eventually there's a high likelihood that you're actually going to pass a challenge. Now let's look at the lucky streak. What does the lucky streak mean? We obviously know that at times with some of the worst strategies and one of the worst approaches to the market, you can still be profitable. How many times have you seen a friend that's, you've literally invited them into trading and within a month or two, they're already funded? It might be down to this. Have a little look. With a lucky streak of win after win after win, what's the likelihood? Even for the 1-to-1 and the 30%, you're only 5 to 10% likely to actually pass that challenge. Where you're really getting into the higher numbers is once you're getting into at least the 50% win rate / the 1 to 3 risk to reward. You can kind of see in this level over here, you're really not going to be doing that well, even with a bit of luck on your side. Now, you know where people say, for example, luck can be planned for, and it's exactly the same thing as trading. If you have a 70% win rate with a 1 to 5 risk to reward, you're really having them high odds to actually get into them lucky streaks. Now, again, luck is not what we rely on. We rely on systems. We rely on the times where our systems are the worst. And that's exactly why we looked at the failure expectancy streak as well. Now, what I've gone ahead and done is I've compared two systems, the 1% risk and the 2% risk system. The first one, we're looking at the losing streak of 2% risk. We obviously know with a drawdown of 10% overall, we can only go for 5 losses in total. So with a 2% risk and 5 losses in total, what's the likelihood of that? To be honest, the only thing that matters with this is going to be the win rate, because we're expecting 5 losses in a row, correct? So with that, we can expect with the 30% win rate, you're going for that 16% chance that you're going to lose the account. I'll be honest, 16% is quite high. That's almost 1 in 5 prop firms that you actually take. If you take your trades completely blindly and you know that's your system, a 30% win rate is still not going to cut it. A 50% is a lot more normal. 3%, which, what's that? 1 in 50 challenges even. And then 70% as well is almost negligible completely. Now, if we take this down a notch to 1% risk, so that's 10 losses in a row, what you actually see is that any win rate is actually fine. So what does this mean? It's very, very unlikely that you're going to enter 10 losses in a row. How many times have you guys lost the challenge because you've consecutively lost 10 losses in a row? It's not very likely, right? Most of the time is due to overtrading, is due to your risk management, and possibly your psychology, of course, as well. But if you actually stick to your strategy, it's very unlikely you're ever going to lose an entire challenge like that. And the final test that I've actually gone and done is the Monte Carlo test. For those of you that don't really know what it is, essentially it's an algorithm that has tested a certain, how can I say, for example, a statistic or a probability, and it tests it over a certain amount of trades. Monte Carlo test can be used on many, many things, and it's a simulation type of thing where we can also use it in our trading as well. A lot of the popular backtesting platforms like FX Replay, even for example, TradingView, or even, TradeZella or whatever, you've got these types of things. Now let's get into the idea behind it. So with a Monte Carlo test, it's tested the exact strategy. Let's say a 30% win rate with a 1-to-1 over 10 trades. What's the likelihood you're going to pass? Over 10 trades, there's no chance you're going to pass with a 1-to-1 and a 30% win rate. Because think about it, you've only got a span of 10 trades to actually look for. With a 70% win rate between a 1-to-3 to a 1-to-5, you're well in that time where within 10 trades, you're bound to pass. Even stepping it down a notch to a 50% and a 1-to-3, you're still at a 64% chance. So what does this mean? Does it mean all of these in the amber and the red zones cannot be traded at all? No, it simply means you need to get more trades in. And that's what you see over here. Over the span of 20 trades, we can level it down to even a 50% at a 1-to-2. You've got 64% chance of passing within 20 trades. So generally what this means is between 10 to 20 trades, if you are within this section over here, you are very, very likely to pass. And that's exactly what you've got to stick to. Now, I hope everything that I've actually looked at kind of, compiled together really shows you if you've got an exact system that works and you've gone out and got the data for it, all you really need to do is stick to your risk management, whether it's 1%, whether it's 2%. But what is the best strategy that you can actually use in terms of passing these prop firms? Well, it's very simple. You need at least a 1-to-3 risk to reward with a 50% win rate. This I've seen across the Monte Carlo test, across the losing streak test, every single thing, you're going to see it in green. However, when you start to level that down to a lower win rate or a lower risk to reward, you're going to be seeing discrepancies. Now, if it's in a lower time frame entry, what you're going to be looking for is a 1% risk. So no more than 5 to 6 trades per week. Overall, by the end of the month, that will generally equate to around 20 to 25 trades throughout the month. If you're going for a higher time frame approach, you can actually go for that 2% risk, and you only need 2 to 3 trades per week. Now, generally speaking, what do I actually recommend as well? Go for a time frame that suits your personal life and that actually gives you an average risk to reward or an average win rate and also an average risk to reward. So anywhere around the 1 to 2 to 1 to 3 in terms of risk to reward, and your win rate keeping it around that 50% or so. You simply do not need to go for the moon every single trade. I think a lot of people struggle with this concept where they're trying to go for the high risk to reward trades because they're trying to make as much money as possible. Remember, when you're passing these prop firms, you're not trying to go for 20% or even more. You're literally just trying to hit that 10% or 8% or whatever it is and pass. My personal favorite is the 5-minute chart. And by the way, if you're wondering how exactly I enter my 1 to 3 risk to reward trades, I've completely left down a 7-module advanced liquidity course down below. It goes through my exact strategy. It's completely free, quick and concise, and very easy to understand. So it's all just bite-sized videos. So you can click one of the links down below. Now, let's take this a bit further and actually understand what factors can give us a further edge. Yes, we understand the 1 to 3 risk to reward needs to be, applied. The average win rate as well needs to be around 50%. But what else can we look into? Well, number one, we can improve our risk to reward by dropping to a lower time frame. So let's say, for example, you're usually a 1-to-1 risk to reward trader, trading on the 1-hour time frame. Why don't you take that down a notch to the 15-minute or perhaps even the 30-minute? You're definitely going to see some sort of improvements with your risk to reward because of your entry execution. The second thing, we can actually improve our win rate to at least 50%. Now, the only way that's done is you have to really go out and test it. And again, the more factors you put into, the more constraints you put into your strategy, the more restricted you are as a trader, naturally your win rate is going to increase. So you're not going to enter off any supply and demand zone. You're going to enter off only the ones that give you high quality signals in a way. The next thing, only go for A+ setup. So this is exactly similar to the last point as well. You only want to look for your exact A+ setup. Once you've got that dialed in, and by the way, I talk about that in the entire 7th module free course, my exact A+ setup. It's an Asia sweep below, looking for that golden confirmation and then eventually entering. That is my A+ setup, linked up with a higher time frame and linked up with a few other things as well. You want to define that for yourself. The next thing, you need to go out and choose a prop firm with better market conditions. I know some of you like the idea of, some prop firms have amazing discounts, so I'm simply just going to go for them. What you really want to be doing is going for them high quality prop firms that have been around for a while and you can really trust. Now, what matters with a prop firm that is trusted? Number one, they've got a good track record. So one thing you can actually look at is Trustpilot reviews. If you look at the likes of Funded Next, FTMO, Alpha Capital, all of these really do have high quality reviews on Trustpilot, and usually you can suss them out that way. Number two, they have a good history and have been around for some time. Generally speaking, any prop firm that's come out in the last few months can be quite high risk. The first month or two, they are guaranteed to pay you out because they're looking for people to pay out. But eventually after that, business struggles a little bit because their marketing has stepped down a little. That's typically what you see. How many prop firms, and I'm not going to name any, but have been led by marketers on Instagram or whatever, and is simply just broken down after a few months. They had a very explosive period in the beginning where everyone was running towards them, and then they just disappear off the face of the earth. You get that many, many times. Number three, they have good trading conditions to actually pass. One example I can give is, let's say, for example, the spreads. Let's say, for example, the pass-in requirements, whether it's 10% compared to 8% or even lower than that. Finally, do they have good support and incentives as well? This is one of the biggest things because a lot of people struggle with this. Many people actually pass accounts and then eventually they're completely denied some payouts. We do not want to experience that at all. So what I've actually gone ahead and done is I've actually compared all top prop firms, and I'll possibly leave a link down below in the description and you'll see my top prop firms listed out, and I've looked at all the rules as well. You can have that for completely free. I've looked at FTMO, Funded Next, 5%ers, Alpha Capital, and Funding Pips. And to be honest, all of them are great. I'm going to be completely real. They've got great reviews. They've got good rules. They've been around for quite some time as well. All of these have been tried and tested. It's not something that's just popped up in the past year or so. My opinion, and this is being completely truthful as well, is the number one choice is Funded Next. For me personally, it was between two or three in a way. You've got FTMO, which would be considered as number one. Then you've got Funded Next and 5%ers. With that, what I've seen is this. Funded Next gives some of the best incentives, and they really are on par in terms of prices and with everything compared to some of the others. So for example, The challenge phase from every other prop firm, you actually don't make money from that. But from Funded Next, you do. You get 15% profit share from the money you make within the challenge phase. The next thing, you get a slightly easier challenge than FTMO as well. 8% in phase 1, 5% in phase 2. Payouts, if you don't get paid out within 24 hours, they actually give you $1,000 on top as well. So that really is what makes a difference when it comes to this entire thing. And then also up to a 95% profit split with which some of the others don't have. And the one thing that honestly really makes a difference is they don't have hidden rules like some of the others. Funding Pips, I realized, had some hidden features that would, affect your trading. Alpha Capital had some hidden features that would affect your trading. What I've seen is FTMO is pretty straightforward and Funded Next is pretty straightforward as well. So these two honestly have got to be some of the most trusted. And by the way, only for the next few hours, and I'm literally talking about the next 2 days from this actual upload, they've got a 40% off when it comes to the futures trading. So if you use the code DCapital, I've left a link down below, you can actually get 40% off discount. Now, I'm going to be honest, there's a lot of prop firms out there that give these types of discounts, but Funded Next is known to not really give them. So if you really want to take that opportunity and get into funded sort of the future scene, then definitely take that opportunity. Literally a 50K account for $150. I know a lot of people are spending that money on literally shoes or whatever. So, it's just about what you prioritize, to be honest. When it comes to the CFD space, use the code Diamant and you'll get the best deal possible, and that will be applied automatically as well. So even if you don't sign up to Funded Next or any other prop firms, just be aware that these are some of the top ones in the entire space. And by the way, just a final little tip that I want to add onto everything as well. There's two approaches you can take to prop firm challenges. Number one, you've got a risky approach. So let's say, for example, you're only willing to spend $1,000 on a challenge. What you would go ahead and do is basically purchase one 200K account. The problem with that is, let's say you've entered a losing streak because of market conditions or whatever, you're bound to lose that account. However, let's take a safer approach. If we're only willing to spend $1,000, same scenario, what we can do is we can actually purchase 4 50K accounts. And we can actually take a bit of a slightly riskier approach. We could even risk, for example, 2% per trade and everything like that. The problem with that is you're not looking to get all 200K allocation. You're probably going to get, let's say, 100K or maybe even 150K, because you might lose a challenge being slightly more risky, but you're going to pass it quicker and you're going to get that. Essentially, you're going to get them payouts at some point. So that's definitely something I recommend. Stick to the smaller sizes, especially in the beginning, and only scale up to the bigger prop firm challenges when you have that capital. For me, for example, at this point, it makes sense because obviously I've been trading for a while. I've got that reserves that I can actually go into and take these challenges. I know, for example, the return on investment for most of the profitable traders are literally, 20% or so. A person might spend 10K to get back 40K on these prop firm challenges. So don't be afraid to fail. Go for the challenges, but in a more with a proper plan in place. So some key takeaways from this entire video. What I want you to do is this. A one-to-one strategy is a definite no, unless you've got a crazy win rate, something like 90% win rate or so, which is quite rare to see nowadays. Number two, the most important factor is keeping everything consistent. Whether you trade a high risk to reward strategy or whether it's a low one, it really doesn't matter. As long as you can stick to that and know that the higher risk to reward you go, the lower your win rate is. Me personally, I like to have a balance. Also, you should be aiming between 10 to 20 trades a month with an average risk to reward and win rate. That's something that I'm kind of experiencing myself. For example, I usually go for them 1 to 3 risk to reward trades. And generally speaking, I'll get around 10 trades a month, 10 to 12 trades, something like that in a usual good month. And I've seen that through continuous years of testing. We've got years and years that I've tested personally with my team for the entire strategy. Number 4, split your investments into different size accounts. And that really should be it as well. So guys, if you did actually enjoy this video, please like, comment, and subscribe to the entire channel. I really do appreciate this. If you want to see more of my face throughout the entire videos, let me know as well. Or do you want to keep it just a simple canvas? And if you do want to actually watch this 1 to 3 strategy that I actually do use, I've broken it down in a simple video. It's literally around 20 minutes long. So definitely have a little look at that. And guys, I'll see you all in the next video. Take care.